All right. Hello. My name is Lana Williams. I'm a financial coach based here in Atlanta, Georgia. And I am very, very happy to have Willie Smith, a mortgage lender, here with me today. The housing market is such a big topic today. Interest rates are higher. Folks are wondering what's going on with the pricing. So we thought this was a really good time to get together and answer some questions that we've received from some of my clients and from some of Willie's clients. So, Willie, welcome.
Thank you. I'm so happy to be here and excited. Hey, this conversation has been kind of in a long time coming. We've been planning this for a while.
Yes, we have. We have. And I'm happy that we've both been busy, right?
Yes, yes,
So,
that's a good thing. That's right. That's right. We're never
yeah.
gonna complain about being busy.
Absolutely. So, why don't you tell everyone about yourself and your business, and if you don't mind, a little bit about what you're seeing in the market, and then we'll jump into answering people's questions.
Absolutely. And again, thank you for the wonderful introduction. My name is Willie Smith, and I'm a certified mortgage planner. It's going on 2.5 decades now for me being in the business. It's really all I've really ever done since I graduated college several many moons ago, and I absolutely love it. I'm blessed to be a father, a husband, have 3 boys, and banking is what I do. Having that certified mortgage planning designation, basically the focus is helping folks, build wealth and legacy through the acquisition of real estate. That's what we do. But also doing it in a very, very smart way, in a responsible way, so that, folks can, leverage the resources that are out there and available to, everybody.
Yeah. I love what you said because one thing that I'm sensitive to as a coach, and we both have, have similar backgrounds, right,
Yes,
in the
yes.
financial industry.
Hmm.
And one thing that I picked up that I think you are sensitive to also is the people will do things and make financial decisions, and
Hmm.
sometimes it seems more like a trend.
Right, right.
And when I think about real estate and home ownership, I think wealth building.
That's right.
I think acquiring assets.
That's right.
And so when you make decisions, my guidance, and I pick up that your guidance is
Hmm.
to make smart, responsible decisions that are going to
Right.
benefit you in the long run.
Absolutely. And what it starts with is really, we try to break the mortgage process down basically into 4 pieces. And it's 4 very critical pieces that all need to be handled and pursued with tenacity so that you can have that success when you get to the end. Number one, and I know you preach this a lot, is you have to have that budget. You
Yeah.
have to establish your budget. You can't go to the bank and ask us how much do we qualify for. Like that is just not a good way to start the mortgage conversation, because understand, the bank, we're all about lending money. We want to lend everybody $1 million if we could. My wife will be very happy with that. So you have to come into this situation knowing what your budget is or have an idea of what you can spend. The next thing is you must have your long-term and your short-term financial goals established. You have to know where you want to go in order to know which lane or what road you need to travel to get there.
Yeah.
If you don't know what your goals are, how do you know what path to set out on in order to get there? Then you want to work with a mortgage professional who's really crafting that mortgage plan that's specific to your situation, because every we could have 50 FHA loans and all of them have different scenarios.
Yeah.
We could have, 50 conventional loans, all of them different scenarios. So the mortgage plan has to be crafted to meet your specific need. Then you have to put your team around you that's going to help you execute, hold you accountable, make sure you stick to the plan, make sure you're doing the things that are going to line up with the budget, long-term and short-term financial goals, and then also the mortgage plan that fits your needs. So that's it in the beginning, you must have that type of, plan in place if you're going to come out on the other end and be successful.
Yeah, we speak the same language.
Love it.
We speak the same language, and personal finance is just that,
That's right.
personal.
That's right.
And so everyone's situation is different,
That's right.
so we do want to tailor it. So
Hmm.
you want to get into some of these questions?
Sure, let's do it. I'm ready.
Okay, so the first one, should I buy or should I rent? What are your thoughts on that?
You know what? That question is a big one. And it's coming out a lot right now.
Yes.
But let me also say this part first is that a lot of times, no matter what market folks are in or what market cycle we're in, when someone is fearful of buying or doesn't want to make that commitment or that step, no matter what market cycle we're in, we always get that same question:
Yeah.
should I buy?
Yeah.
Right?
Mhm.
2 years ago, year and a half ago, rates were 1.99, and folks were still saying,
Should
should
I?
I buy? Right?
Right.
So the thing that I'll tell you is, and it goes back to the first thing we talked about, you don't have anything to be worried about if you're staying within a budget.
Mhm.
If you're going out there and you're looking at your finances and you've established what you and your family can handle for that housing expense and you're staying within your means, right? That is the thing that's going to help you always make a great buying decision. The
Mhm.
problem with it is that when you go out there and you know that your finances say you can afford $2,000 a month and you go get a $2,800 mortgage payment. So now, then that's less of it, and then you end up in a bad spot. But that isn't a situation of because you bought at the wrong time.
Mhm.
That's a situation where you bought outside of a budget that was comfortable for you, that was going to allow you to also meet your other needs.
Yeah.
So when someone asks me, is now a great time to buy or should I buy now? Absolutely.
Mhm.
Because we know that there's going to just the nature of the market is cyclical. Things are going to be up and down. Rates are going to go up and down. And from your background in finance, trying to time the market is not possible,
Right.
right? No one knows when things are going to dip, spike, or whatever the case may be. But if you go and you purchase a home and you're getting yourself into a mortgage payment that fits your budget, that you can handle, you're making a great decision. The
Yes.
other thing that you have to think about is what happens if you don't buy,
Mhm.
right? So let's do some real easy math. If you're paying $2,000 a month in rent, and these days that's a deal, that's $24,000 a year. If you wait another 3 years before you buy, you have thrown away what almost $75,000
Yeah.
that you have nothing to show for. You're not, paying down a mortgage or amortizing and building equity. You're not being able to take advantage of an appreciated asset.
Mhm.
None of those things. So, is it a great time to buy? Absolutely, especially if you're going within your budget. And the sellers are being reasonable again now. A year ago, sellers were so much in the driver's seat that you had to overbid for the property. They wouldn't do any repairs. They wouldn't negotiate to give you any type of concessions. The market is still hot, but the sellers are being reasonable again.
Yeah.
So, great opportunities and great resources available to buy right now.
Yeah, yeah, good. Yes, I'm gonna concur and add a, little bit to that is, what we've been saying thus far is what is your goal,
That's right.
right? Which
That's right.
is what you're saying. And so, just like you're saying, if it works with your budget, right? Then that's the move that you want to make if your goal is to acquire assets, right?
Hmm.
Because
Hmm.
we can't control the market.
That's right. That's right.
Yeah. With my coaching clients, and I'll shed a little bit with us with my coaching clients, I do look at the now versus 3 years and 5 years. And sometimes we get into the conversation is the right time for me right now based on all of the factors in my life.
Mhm.
And I would say, really, that would be kind of the only deterrent. Yeah.
Yeah,
Hmm.
and it's such a personal decision, but the big but that I always have when I'm having a conversation with the client is this: you're still going to pay a housing expense.
Yeah.
So one thing that we know for a fact, we're going to have to pay for somewhere to live.
Hmm.
So when we're going in and folks are balancing out and deciding what to do, understand that you're going to have to pay some type of housing expense.
Yeah.
So if you can make it work, even if you're not buying that dream house, because many times the first house isn't the last house. It's not
Hmm.
like grandma and great grandma who buy a house and they're there for the next 60 years,
Right.
right? These days, folks buy 3 or 4 homes in a lifetime.
Hmm.
So even if you may not be necessarily be ready to buy forever home,
Right.
maybe it's a situation where you can buy a home that may be able to, again, allow you not to throw money away with rent, not continuing to pay the landlord's mortgage because you're paying a mortgage, just
Right.
not yours, not having that and being able to take advantage of buying these properties. And real estate nationally is still rapidly appreciating. So
Hmm.
you're able to, again, one of the things you preach, spending money on appreciating assets versus depreciating assets. So again, don't get so caught up on, hey, I can't buy that dream house right now. Let's take that first step because you're investing in an asset that 3 or 4 years down the road is going to still put you in a better position, especially since you were going to have to pay for a housing expense anyway.
Yes, yes, absolutely, absolutely. All right, so the next one. Share with us different types of loans, and I have two people, not two people, but two types in mind. So, if you don't mind, a little first-time home buyer,
Mm-hmm,
and then so kind of what are some of the programs we always
mm-hmm,
hear about programs,
mm-hmm.
and then your average Jane and Joe.
Okay, yeah. So absolutely. So it's basically the same. The crazy thing about it is that 2.5 decades in the business, and when I started out, the 4 loan types were USDA, FHA, VA, and conventional. 2.5 decades later, what are the loan types? VA, FHA, conventional, USDA. The loan products have been, set for years and years and years. So then it's a matter of determining which one of those products are going to fit for you. A lot of times, a lot of the first time home buyers take advantage of FHA just because more relaxed underwriting guidelines, you know, FHA is a little bit more lenient on the credit requirement. A lot of times they work very well with the first time home buyer or the down payment assistance programs. So one thing I also want to help the our audience understand is that there is no such thing as a first time home buyer loan. What it is it's the first time home buyer program, and it's giving you down payment assistance. So for instance, you may go out there and you're doing the first time home buyer program that's giving you down payment and closing cost assistance. You go out there, you buy a $300,000 house. The down payment is approximately $10,000. You don't have $10,000, so then you may take advantage of one of the down payment assistance programs that's going to give you a grant. Sometimes they're forgivable, sometimes they're repayable. So instead of you having to come up with that 10 grand for your down payment, the down payment assistance program gives you assistance in purchasing the home, but the underlying loan is still going to be FHA, conventional, VA, or USDA. And I can tell you right now, there are a lot of resources out there available for folks that need that down payment assistance. Now,
Mhm.
down payment assistance doesn't mean that you don't need any money. Down payment assistance just means you need less money. Okay. Now, for the folks that are not first time home buyers, again, the regular traditional products still are in place. Again, USDA, conventional, FHA, and VA for our veterans or active duty military. So, no matter where you are, whether you're that first time home buyer, that second or third time, or that move up buyer, the investor, whatever the case may be, there's plenty of money. There's more resources out there now than I could ever recall over years and years and years of being in banking. If you have a desire to purchase a home, the money and the opportunities and the resources are out there for folks to be able to do it.
Ah, that's good news. That is really, really good news. Okay. So, along those lines, here's a question. What do lenders look for?
That's a good. You're on fire. So
Yes.
let me put this one out here first. We're not looking for perfection. A lot of times, one of the biggest thing that hold folks back is they've already talked themselves out of the loan before they've even applied, right? You know, we're going to look at the four main pieces. We're looking at income, employment, assets, credit. We want to see stable income. We want to see stable employment. We want to show you've been getting up going to somebody's job every day, right? That's what we want to see.
Right.
Now, one myth that you hear a lot is that you have to have been on one job for 2 years. It's not true. You do not have to have been on one job for 2 years. We're looking for a 2-year work history. So we want to see that you've been consistent. So consistent with your income, consistent with your employment, assets. We want to see not necessarily a certain amount of money in the bank, but we want to see that you've been responsible with the nickels that you're blessed with. We don't want to see $5,000 coming in, but $6,000 going out each month. That's not what we want to see. So we want to see responsibility with, your assets. And then the fourth thing, we're going to look at credit. Yes, we're going to look at credit because we want to see how you've paid others, because that's a good indicator on how you're going to pay us.
Mm-hmm.
But we're not looking for perfect credit. We're looking for responsible credit.
Mm-hmm.
So all of our audience, you're thinking of four things, the four bases, the four pillars, like four corners of a house: income, employment, assets, credit. We want to check each one of those boxes to make sure that each one of those pillars, or you put yourself in a good position so that we can feel comfortable with lending the money. And understand this: we want to lend the money. We want to approve your loan. The bank wants you. Anybody who's listening to this and thinks that the bank doesn't want to lend you the money just as bad as you want to borrow it and get your house, understand we are in the business of lending money, but we're also in the business of wanting to get paid back. So in order for us to be comfortable with lending, you have to make sure that the income, the employment, the assets, the credit, those things are in line so that we can feel good about this person's going to pay us back.
Excellent. Well, they're definitely not nonprofit
That's right. That's right.
organizations, right?
Yes, we are for-profit organizations for sure.
One quick question. You mentioned income, employment. What about residence? Is that a consideration if you've been at the same address for a number of years? Do you guys
Well,
look at that?
yeah, we like to see the stability of it. Is one of the things where it's not necessarily making or breaking the credit decision,
Uh-huh.
but we want to see that, that you haven't been hopping around every couple of months,
Gotcha.
right?
Uh-huh.
So if you've been home, a lot of folks are still living with, parents or relatives or whatever the case may be, and that's fine. Or if you've been out on your own, we want to see that, you have a stable, rental history. Now,
Okay.
depending on the strength of the finances, the rental history may not make a difference one way or the other. But then sometimes if you have something that maybe is a little bit more marginal, showing that you have a strong rental history sometimes is the thing that can put you over the hump a little bit.
Okay. Okay, great, 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 great. Okay. Our next question, and let's see. Actually, I'll take a stab at this one and
Okay.
definitely jump in. So it is, what's the best way to save for a down payment?
Oh wow. I'll let you
Yes.
start. That's your
That
that's your wheelhouse.
that's my wheelhouse. That's a good question, and I won't go too technical,
Mhm.
okay? But really the best way to save for anything is to, if you're saving for something specific, you want to isolate it.
Mhm.
In other words, open a home buying savings account, right?
Mhm. Mhm.
And that's just opening a high yield, right,
Mhm.
savings
Mhm.
account, which are
Mhm.
paying about 4
Mhm.
4% right now,
Mhm.
doing
Mhm.
really well. And so the purpose of that savings account is that is money that you're putting in for, right? The
Mhm.
purpose of buying your home. Um, and you want to decide how much you can save, right? You want to budget, go through those expenses to see if I could squeeze out a little bit more. You want to set a timeline to do that. And just, just throw money at it. If you're a couple, one key thing that I want to stress with couples, especially if there's a variance in incomes, right? So if one makes a lot more than the other, really think about a percentage
Mhm.
of your income versus both of you putting in the same amount. So if someone makes one, partner makes 50,000, the other one makes 150,000, it doesn't make sense that they both,
Right.
right,
Right. Right.
contribute the same amount. So you want to say we're going to save, 5% of
Mhm.
our incomes, and then that makes it fair.
Yeah.
Um, so yeah, I'll stop there because I can go on and on and on about this. So any thoughts on your end?
I think those are wonderful points. And the thing with the savings is also making a commitment to it. Because when you sit down and you look at that budget and you look at those bank accounts and you look where your money's really, really going, sometimes that budget will strip you down and let you know, like, really, I'm doing what? Because now it's right there in your face. So going in and kind of tackling it head on to see exactly where money is going and then making that commitment, whether it's individually or if it's a couple doing it. Now, I love to separate, to isolate. I tell clients, hey, do your savings account at a totally different bank. Don't get a debit card or an ATM card. So if you need to go and get that money out, you have to get in the car, walk in the bank, and make a decision. Don't make it easy. Now, it obviously is there if something, really huge emergency comes up. But again, isolated is great so that you can go and you can make that commitment to the savings. But I think the biggest thing is the commitment to it. Really, really saying, hey, you know what? I want this house for my family. I want this house for me. I want to start this wealth building journey. And real estate is still the biggest wealth building vehicle out there. It just is,
Yeah.
you know. But we just have to go in and just go after it. And sometimes it requires sacrifices, but making those sacrifices now will pay off for you big time down the road for
Yeah.
sure.
Yeah, absolutely. And honestly, if you plan, it's not a sacrifice. You're working your plan, right?
Absolutely,
Yeah,
absolutely,
that's all you're
absolutely,
doing. So,
absolutely.
okay, good, good. Here's another one, and I'll take the lead on this one too. Should I pull from my 401k or retirement account to buy a
Mm,
house? Do you
mm.
see that a lot? I'm
I
curious.
do. I do.
Okay.
I do it. I do, and it depends on the situation
Mm-hmm.
um that I've seen. I've seen the hardship withdrawal where
Uh-huh.
folks are just taking the money out
Mm-hmm.
um because for the folks that don't know, you can pull the money out of your 401k without penalty as long as you're doing, financial, buying a primary residence or financial hardship or higher education, blah blah blah.
Mm-hmm.
So it is a potential resource. But then I'm also seeing a lot of people doing the 401k loans
Mm-hmm.
where they're taking a loan out against the 401k and they're basically serving as their own bank and
Yeah.
paying it back.
Yeah.
So my take is if you're pulling the money out of the 401k, whether it's a hardship withdrawal or a loan, and you're using it to buy an appreciating asset and you're doing it responsibly, you can leverage that to put you in a great position. If you're pulling money out to buy jet skis or a Cadillac, it doesn't make any sense. So I kind of break it down to that because, quite frankly, there's folks that are paying $2,000 a month, $2,500 in rent, don't have the money to do the down payment or the closing costs or whatever, and they're kind of throwing 30 grand away a year when they have a few nickels in their 401k that they can pull out, purchase the appreciating asset, still have a big enough horizon to maybe replace that money, but then also be able to be building equity in that real estate to kind of offset some of the money that they pull from the retirement. So I can't say across the board it always makes sense, but if folks are responsible with it and they understand it and they're doing it to put it somewhere that they're investing where they're getting a return, I think it could be a very viable option.
Yes, yes, option. And, as a coach, so I work with outside of budgeting, debt, right, building savings, is I really get into kind of the psychology, the mindset, right, of my clients. If you were to ask me that question just right off the cuff, my initial response was I would try to avoid it,
Agreed.
right? And
Agreed.
keep it in mind what Willie said. And the reason is your 401k is wealth building as well. And it's long-term wealth building in its assets, right? But the biggest asset that we all have, especially with investing, is time. And so if you start investing at age 25, you're going to have a drastically different outcome than if you start investing at 45, right?
Absolutely.
And
Absolutely.
so you're pulling that money. In other words, you're relinquishing the time that that portfolio could be building. And I'm not a fan of that. Um, and then, if I have a client with a lot of credit card debt and they can't stay out of the home decorating stores
That's
and
right. Right. Right.
yeah,
Stay out of Lowe's or Home Depot.
there is
That's right.
absolutely no way that I'm going to recommend that you pull money from your
That's
401k.
right. That's right. Yeah. It goes into, like what you said with the budget, long term, short term, mortgage plan, execute. It still goes back to that.
Yeah.
So the first resort would be let's tighten that belt and figure out how we can save to do what we need to do.
Yeah.
Now,
Right.
having a 401k over there is something that is an option, but it doesn't necessarily need to be the first option, you know, um, especially if you have the means and the resources to save and to make it happen, but you're just choosing not to do it.
Yes.
Or
Yes.
you have your plan in place, but you're not sticking to the plan. And that's where it comes in to be a very, very healthy conversation about what's the best way to do this. And it could be a situation where you lean towards the 401k loan because then you're not touching your principal. You're basically borrowing against the asset of the 401k.
Right.
You're paying it back through payroll deduction, and you're basically serving as your own bank.
Yeah.
So in that way, you're getting the money to help you, but then you're also protecting, that long-term investment where time is going to grow. So that could potentially be the best of both worlds.
Yeah.
But at the end of the day, having someone like you to be able to say, hey, listen, these are what your options are. These are the things that you should be to do. This is what you should consider. And then again, craft that plan that's specific to your particular situation.
Yeah, yeah. And one more thing, and Will, on that point, and this is really just to give people options, is it doesn't have to be the end all be all. You can start with a smaller home.
That's right. That's
That's
right.
more affordable, right?
Absolutely.
And then
Absolutely.
plan appropriately for the bigger home, right? So, yeah.
And you know what? We need a big sign of patience. Patience.
Yes.
I remember, true story. I remember our first house. We were in Virginia. That first house we bought was a 3-bedroom, 2-bath townhome. We didn't even have a backyard. You walk back there, you could barely turn around. But I tell you what, my wife went and she painted it and she decorated it and she did what
Right.
folks do.
Yes.
And we had 2 kids there. And when it was time for us to go, and we sold that house, and then now that equity was the down payment on the next house.
Right.
And sometimes, folks, we just have to be willing to grow into things.
Yeah.
We have to, the first house likely will not be the last house, but just take that step, start somewhere, and understand that there's steps that you can take to really, really, really put you in a very good position. It
Yes.
really, really can. But you just have to, you may not be able to jump to step 10. You got
Yes.
to be happy and comfortable and enjoy the process of step 1, 2, 3, 4, 5, knowing that you're getting to where you want to be one day. May
Yes.
may just not be today.
Yes, yes, absolutely, absolutely. And I tell you, being in a home that you can comfortably afford feels
That's right.
real good, right?
Yeah, that's a
Yeah.
that's a big deal. Yeah, 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 yeah. That's a real good one.
That feels
Yeah, yeah, yeah. And again, it just goes, and we're being a little tongue in cheek about it, but when you go in, you do not want the stress each. But again, it goes with anything. You don't need to go get a $700 car payment if your budget says 375.
Yeah,
You
right,
don't need to go spend 10 grand on a vacation when your budget says 3,000.
right,
You don't need a $35,000 wedding when your budget says, 10,000.
right.
It goes into so many different things.
Yeah,
Don't buy a $250 pair of tennis shoes if your budget says 50.
right.
So you have to be responsible and do things that make sense with the little things, or you're going to just continue the same path of overspending, stretching yourself further than you need to,
Mhm.
and it just starts with those little smart decisions, and they're just going to get momentum, you
Yes,
know,
yes,
just as like small little decisions
right.
get momentum as well.
Exactly,
Okay, which
exactly.
one you going to do?
Yes, 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 yes. We are hopefully people are hearing a theme with us. I
Mhm.
think they are. Goals, planning, budgeting,
Right. Mhm.
responsibility. Yeah. Let's see. Next question. How can I budget for new expenses if I don't know what they are yet? That's a really good question. That's a very responsible question too.
Right,
So,
right,
so I
absolutely.
like whoever asked that. So the rule of thumb from the financial house, right, from the coaching house is you want to have at least 1% of the value of your home,
Okay.
right,
Okay.
set aside for annual maintenance and repairs.
Hmm.
So, in other words, if you have, the value of your home is 300,000, you want to
Hmm.
have 3,000,
Hmm.
right? All
Hmm.
right, that's the amount that
Hmm.
you want to have saved. If you are trying to plan, like let's say you're in a two-bedroom apartment, right,
Hmm.
and you're about to buy right a home that's double the square footage or whatever,
Hmm.
use that same rule of thumb, right? Just kind of your electricity is going to go up. If you're in an apartment, you may or may not be paying water and all of that. So just use that same rule. So kind of save up about $3,000
Hmm.
and you're going to be more than safe until you figure out, right, what you need. Because included in that is going to be things like, getting things installed,
That's right. That's right.
right?
Absolutely.
Buying a new, you may have new appliances, but you may want, this feature versus that feature.
That's right.
So using that same rule will kind of cover all of that. And
Hmm.
then and plus, in addition, without a doubt, something's going to pop up the first year or two that you're in
Hmm.
that home that you
Hmm.
didn't expect, right?
Hmm. Hmm.
So you're covered, and then if you don't use all of that, just roll it into that general household fund.
Yeah, I think that's a great tip. And one other thing that I would encourage folks to do is that when you purchase that first home, or the next home, one of the things you can negotiate is either is getting the seller, if you can negotiate it, to pay for your home warranty,
Uh-huh.
or you do your home warranty yourself. So what that does is, it gives you that little bit of protection there. So if something goes sideways, once you get into the home, you have the protection, and the warranties are very affordable,
Mhm. Yeah.
and again, I'm real big on, hey, when during negotiations, asking the seller to do it. If
Mhm.
the seller doesn't want to do it, you come up with a couple of $100. So if you don't have the money set aside and then it's stressing you out, okay, then you may be able to, you can buy yourself some time and give yourself some extra peace of mind with the home warranty. And then you can, save through that first year, 2 years, or whatever the case may be. And when the time comes up, you can say, hey, I want to renew the warranty, or you can say, hey, now I've caught up with my savings and now I have a good backdrop.
Yeah.
So that is a very good thing to do. And another thing that I like that you said is, hey, if you go in and you set that money aside and you end up not needing it, you can just roll it in. It's never bad to save. Never. We can be here for the next 15 hours. There's not. So worst case scenario, you save the money and you didn't need it for that reason. Now you just allocate it to something else, or you say, like, there's never going to be a bad bad outcome of you saving.
Yeah. Yeah. I had a client say to me once, and I remember this, it just struck me, but she said, I have never saved money and said that was a dumb idea. Right?
Yeah, for sure. It's just, and it's also just a little bit of peace of mind,
Yes.
yeah, we're all living under God's grace, but it's always great to just have that little bit just in case you
Yes.
get a curveball,
Yes.
and just the savings and creating the habit of it is just great.
Mm-hmm. Yes, yes, absolutely. This one I'm going to ask because someone did submit it, but I think you touched on it a little bit with the what do lenders look for?
Mhm,
So the question is, everyone is saying rates are high,
mhm.
but I thought your credit score determined your interest rate, and that's really yeah.
You know what?
Address that.
That's actually a good question. Still, so let me also touch on it another way. So it is against the law for a lender to charge a higher rate based off of your credit score.
Uh-huh.
That's not legal anymore, right?
Okay.
Now, it used to be in the days of the Wild Wild West, 2008, 2009, before Dodd-Frank
Right.
and all this other stuff, you could really as a lender, whatever you wanted, right? So there's no, you technically speaking, you do not get a higher rate based off your score. But what happens is there's a higher cost to get the rate.
Ah.
So
Oh.
it could be a situation where the interest rate is, and again, I'm throwing out a number, 6.5.
Mhm.
And if your credit score is a 740, it may not cost you any additional costs or fees to get that rate.
Okay.
So now you take that same 6.5 and your credit score is a 620. Now it may cost you an extra 2% or 1.5. Like you hear, we ain't gonna go too far down the rabbit hole of discount points and stuff like that. But so what happens is that the person with the higher score gets a rate and it may cost them nothing extra. The person with the lower score could get that same rate, and based off the loan amount, it could cost them an extra six, seven, $8,000.
Okay.
So technically speaking, you didn't necessarily get a worse rate because of it. What you got is a higher cost. So now sometimes when you hear the higher rate because of it, if you can't come up with the money, then what happens is the bank may say, okay, then instead of getting 6.5, you're going to have to get 7,
Mhm. Okay.
because at 7, you don't have to pay that extra cost.
Okay. Okay.
So that's the way that the bank is maneuvering
Uh-huh.
to be able to do it. And
Right.
if you don't know what's going on, it's like, wait a minute. So it's the cost to get the rate.
Okay.
And that's how it's baked in there on you. So
Okay.
the higher the scores that you get, is potentially giving you some leverage. Now, on the flip side of it, like for instance, with some of the first time home buyer programs, they have a minimum credit score. Most of them are 640, some of them are 620. If you have the score, whether you have a 640 or 740, you just getting the same rate across the board. It doesn't matter.
Okay.
But then if
Right.
you're doing traditional non-DPA or first time home buyer, you know, that scale of the cost up and down is more tied into what the interest rate is,
Okay.
based off your credit score.
Okay.
Absolutely. The
Okay.
cost to get the rate. Absolutely.
Okay. Thanks for clarifying that.
Yep. Yes.
And
Yes.
I'm glad you used that word maneuver because I was
Yes.
thinking that like
Uh-huh. Yep.
Yeah. Okay. Let's see. Oh, this is a good question. Will my credit score go down if more than one lender pulls my credit? So let's say they're shopping, right?
Absolutely. Absolutely.
Mhm.
So great question. There's a window there. Now, it's a little bit of discrepancy between the experts on whether that window is open 2 weeks or 30 days.
Mhm.
Most folks lean a little bit more towards the 2 weeks,
Okay.
but I think it's really more so 30 days.
Mhm.
But the credit scoring algorithms are constantly changing, et cetera. What I will say is that if you're shopping for a mortgage, one, let me say this also. You can talk to lenders. You're going to know when you're talking to someone whether you can work with them or not. Talk with your, everybody does not need to review your credit, right? You go with the three lenders if you're going to talk to three, and I can guarantee you within about 5 minutes, some of us less, you're going to know whether you can work with that person or not,
Yeah.
right? And then the person that you feel like you're going to work with, that's the one that you let access your credit.
Yeah.
Now, if you're not sure, and you want to, do your three people and you want give all of them your information and let all of them do your credit, try to do it within that 2 week period to be on the safe side. Because what'll happen is the credit bureaus will look at it like, oh, they're shopping for a mortgage,
Mhm.
and basically, count it as one inquiry. So, but again, we don't want them have them spread 2, 3, 4 weeks apart and you going to different people. We can do that. The other thing about it is don't lose any sleep. Again, we want to be responsible, but again, in all my years of banking, I've never seen someone not get their loan over a credit inquiry.
Okay.
Never,
Okay.
never, ever, ever. Be responsible.
Mhm.
Another thing, ask the lender, can they do a soft pull versus a hard pull?
Okay.
Because a
Okay.
soft pull isn't going to affect your credit at all.
Right.
So let them do the soft pull, which gives us a little peek. We
Uh-huh.
can see what the scores, we can see what we're working with. And then if you decide to use us as the lender, then we can upgrade it and do the hard pull where the inquiry shows up. So
Okay.
when you're talking to your lender and you're doing your interview, you ask them, hey, can you just do a soft pull on my credit? And then there's no bearing. If they're not willing to do the soft pull, try to keep all of those things within that 2 week period if possible.
Sounds good. Yes, and I was going to say not everybody has to pull your credit,
That's
right?
right. That's
You
right.
have that conversation and if you ideally you kind of want to do that legwork and have a
That's right.
pre-approval before
That's
you
right.
go shopping for your home anyway.
Absolutely. Absolutely.
So you have that lender in place before you really get started
That's right. That's right.
shopping. So a lot of times that inquiry period really doesn't even have to come into play. Yeah.
Yeah. And when you're picking your like be real big on that interview. Like make sure that your communication styles are similar. Make sure that, just really when you're talking to your lender, make sure that you're getting someone that is a fit.
Yes.
Make sure that it's a fit because you know everybody isn't the same. And again, and I'm not speaking better or worse.
Yeah.
It's
Yeah.
just you're about to be dealing with that person over the next several weeks, sometimes several months.
Mhm.
Make sure that it's a fit,
Yeah.
and again, you'll know. And then the other thing with the picking the lender, make sure they're saying it in a way that makes sense to you,
Yes.
right? 1 + 1 = 2.
Yes.
There's nothing, if somebody's trying to tell you 1 + 1 = anything more than two, you need to walk out. You need to get up and run out of that office or
Yes.
run out of that conversation. So make it where one, it's a fit personality wise, and two, they're communicating in a way to you that you understand and you get it and that it makes sense. Because
Yes.
again, 1 + 1 = 2.
Yes, 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 absolutely. It's a big decision in your life.
That's
So
right.
big transaction. So yes, that's very important. Let's see. Okay, can I use my emergency fund for the down payment and then build it back up? So the theme in our entire conversation has been budgeting, savings. So I'm highly discourage that, right?
Hmm.
You
Hmm.
always need cash reserves, and
Hmm.
especially when you're moving into a new venture like
Hmm.
buying a home.
Hmm.
And so, again, as Willie said earlier, patience,
That's right.
right? Pull back, pull back. We
Hmm.
get emotional,
Hmm.
right?
Hmm.
We want to have the pretty house with the red door,
That's
right? We
right.
want all of those things. But that's when we want we want to pull back a little bit. And this is something that you do want to be rational
Hmm. Hmm.
about. Yeah.
Hmm. Hmm.
So I guess my answer is no.
Right, right. And I can tell you this is that, you know, the emergency fund and having that in place also gives that peace of mind. Um, and you know, each decision is very much so case by case,
Mhm.
in that when I have clients that I can look at their finances and see that they're very, very, very diligent and they're on top of it and they're doing what they need to do, and they're going to pinch a little bit just to be able to make this happen, but we know that they're going to turn around and put it right back in. Okay, let's see if we can make this make sense. But then I have some clients that really struggle to do everything. Maybe they're just one income. Maybe so if something happens, there's no backup. It's so many different scenarios that are there. So what I will say is this: Coach Lena just made a big point of no, and I agree with that. If we are going to do it, what I make the clients do is convince me that this is a short term, almost like you gave yourself a short term loan,
Mhm.
and you're going to pay that back.
Yeah.
Um, just but it really, really is a case by case. But the overall, I would say, don't mess with it. I agree with you on that.
Yeah, yeah.
Yeah,
And that's a great point. I'm glad you mentioned that because I have clients that get bonuses,
that's right. That's right.
right?
That's right.
They're expecting money. And
Hmm.
so, those things, of
Hmm.
course,
Hmm.
make sense. And I'm glad you pointed that out,
Hmm.
right?
Hmm.
So yeah, good deal. One last question. This is a
Okay.
good one also, I think. Should I get a 15-year or well, mortgages, are they doing 40-year now? I'm
There's the answer is no.
okay.
But there are some niche products that are out there that are kind of playing with the longer amortization.
Okay.
And then even FHA was dangling with the potential of a 40-year if certain scenarios came up with, or sometimes there's modifications that happen in their 40 years. But generally speaking, 99% of the time, most folks are doing 30-year, 25, 15.
Okay.
Those are basically the big three. Now, should you do a 30 versus a 15? So my personal thing is I'm real big on, because we don't have any loans that we do to have prepayment penalties.
Hmm.
So I'm a real big on commit to the lowest payment, because you have the ability to pay extra principal payments
Yes.
and pay it off early.
Yeah.
But then because what happens is you may go in and say, "Hey, I want that 15-year mortgage." And then 5 years from now, there's a change in your finances, and that higher payment is kind of kicking you in the toe. And then you may be in a position where you go to the bank to refinance. Maybe something happened and you can't. Now you're stuck.
Yes.
Now, when you do the 30-year, you're committed to the lowest payment possible. But then we can tell you what the 15-year payment is. You can do that extra to the principal each month, accomplish the same thing. And then if 5 years from now you get a curveball and you can't make the 15-year payment, you can fall back and make the 30-year payment, and you don't have to worry about blowing your credit up. So is 15 smart in that you can accelerate the payoff and pay less interest and all that stuff? Absolutely. But again, my take is commit to the longer term, find out what you would have to pay each month extra to be able to pay it off in the shorter term, and then it keeps giving you the most amount the most flexibility.
Yes, I wholeheartedly agree with that, especially the because you have control,
That's
right?
right.
If you
That's right.
do the 30 year, but then you're in control. And there may be a year that your mother had some medical issues
That's
or
right.
whatever,
That's
and you
right.
have to
Life
lean,
happened.
yeah, lean on that lower payment. I have clients that I prefer them to do it because
Hmm.
I'll spend the money.
Hmm.
And, my response is then we just set that up automatically,
Hmm. Hmm.
right? And so
Hmm.
you don't have to think of like, just forget
That's right.
that.
That's
We
right.
set that up automatically so that you don't have to think about it.
Yep.
And then, clients that I meet with their annual reviews, let's look at the progress you've
Hmm.
made,
Hmm.
right? Let's
Hmm.
look at and see what that extra payment has done, right?
Yes.
Like, don't
Yes.
let that be a mystery. Know your numbers. And so,
Yeah.
yeah, yeah.
Those extra principal payments, it's amazing.
Hmm.
It's absolutely, and that's really the secret that the bank doesn't want you to know.
Uh-huh.
The
Yeah.
bank doesn't want to, the bank does like what we said at the beginning of the conversation. We want to lend you the money. We want the interest over 30 years because you're going to pay us back three times what you borrowed. We love you.
Yeah.
That's why we will gladly give you 300,000 when you're going to pay us back 750,000, 800,000 or more.
Yeah.
We'll take that deal all day. So, but what we don't want to tell you is, hey, paying that extra to the principal each month, how much interest that saves you over time if you're disciplined, how much quicker you're building that equity, how much quicker you're going to end up accelerating paying that home off. That is a tip that more folks don't even take advantage of. So even if you have a 30-year mortgage and you can't make the 15-year mortgage, even if you're putting $50 on the principal each month, it helps. When
Yes.
you get a bonus each year, or you get a tax refund, or you get what, put a little something on that principal,
Yeah.
and it will save you. It's crazy, isn't it?
Yeah.
Like the amount of money and interest that you'll save is mind-boggling. It really,
Absolutely.
really is.
Yeah.
That's an excellent tip.
Yeah, especially at the beginning. I have people start with, even if the intention is not to pay extra,
Mhm,
is we take a payment and divide it by 12, by the
mhm,
12 months,
mhm,
and add that to
mhm,
their mortgage, and that's
mhm.
making an extra payment per year.
That's right. Absolutely.
And that's not, putting you out,
That's right.
right, as
That's
far
right.
as cash flow during the month.
That's right.
And that in itself makes a significant difference.
Absolutely.
Yeah,
Absolutely. That is a wonderful tip, and it's a way to be able to, again, it's just smart.
yeah,
It's just a financially savvy move that you can do, and is making little to no, I would almost say this, taking that payment, dividing it by 12 and adding it should most likely put zero effect on your lifestyle
yeah,
or pinch in your wallet. You're
absolutely.
not going to even miss it.
Yeah.
Right. One Friday you can't go to Applebee's, right? That's
Right.
it. That's the only commitment.
Right.
That's the only thing that commitment is only stopping you from maybe doing that.
Yes.
But it's just wonderful. And again, it's a tool and a way to leverage, because again, it's building wealth and legacy through real estate. It's just
Yes.
being smart with it and leveraging it in a way that is going to put you and your family in a better situation.
Yes, yes, absolutely, absolutely. Well, listen, I knew from our first conversation, I'm like, this is someone that I can send my clients to.
Thank you.
And I think that the theme that we are hopefully sharing with everyone is uh, you know, where whatever your financial goals are, right?
Hmm.
Because that could be, not everybody wants to be a millionaire,
Hmm.
billionaire, right?
Hmm. Hmm.
But I will safely think that everyone wants safety and security and to
That's right.
be able to afford the lifestyle that they want,
That's
right?
right. That's right.
And so the recurring theme that you're hearing, as I, said before, and Willie said a number of times, is first of all, know that all of this is possible, right? Don't let
That's
home
right.
ownership make you afraid, right?
Hmm.
Don't make the
Hmm.
mortgage process, right? That's not a fearful thing. So hopefully we've kind of eased that if that's
Hmm.
some angst that some people have. But with all of your financial decisions, plan, have goals, put some thought into it,
Hmm.
right? And really know where you want to go. And that doesn't have to be an end all be all,
That's
because
right.
in 5 years you could want something different. Your life can look different, right? You could be married, divorced, etc.
Hmm.
But you'll never go wrong with some of the things that we have said over and over, right?
Right.
Save, plan, goals, budget, that type of thing. So
Yeah.
anything you want to add before we conclude?
One thing that I'll also encourage our listeners to do is this. Understand that when you come to the bank and you apply for the loan, represent yourself in a good way. Make sure that your paperwork is organized.
Mhm.
Make sure, understand that lending money has been the same since the days of Babylon, right? You want something, you don't have it, you lend us, we're going to lend you the money, you're going to pay us back with interest. You don't pay it, we have collateral. It's the same basic concept. So when you come to us and make it easy for us to give you money. If we ask for W-2s, pay stubs, bank statements, tax returns, 401k statement, copy of your ID, give it to us. We're not singling you out. What we're doing is justifying giving you the money. So if you come organized, if you come prepared, you have your documents ready and in order, is making it easier for us to tell you yes. So get your pay stubs, get your bank statements, get your W-2 forms, get your tax returns, do your loan application completely. Make it easy for the bank to give you or lend you the money.
I love that. That's a great, great tip. And that makes a difference. Yeah.
That's right. That's
Yeah,
right.
makes a difference. So, well, Willie, thank you so much.
No problem.
Yeah, I hope we can do something similar, maybe some lives where we
Yeah.
have an audience, with
Okay.
some additional questions. So,
Okay.
but I love that both of us are very interested in educating
That's
and
right.
making home ownership and wealth building accessible for everyone. So,
Everybody. Yes.
yeah,
Yes. Thank
yeah.
you so much. It was wonderful, wonderful, wonderful. Loved it. Every second of it. So call
Ouch.
me anytime. I got you covered.
Sounds good. Sounds good.